It's a complex time for the world and global investors. War rages in Ukraine and the Middle East, while tensions run high between the U.S. and China. All at a time when Americans are months away from a consequential presidential election. For the U.S. economy, resilient economic data and hawkish Fed talk is pushing back hopes for multiple interest rate cuts.
We want to gain further confidence.
Whatever the world is pricing in for a soft landing, I think the chance of something going wrong is higher than people think.
At the same time, equities are trading at record levels, and the private credit industry has ballooned to a $1.7 trillion opportunity.
NVIDIA is now the world's most valuable company.
But questions remain about how much further this bull market can run. Are there cracks in private credit starting to form?
There's going to be some likely credit events down the road.
And which market events could throw the global economy into disarray?
Financial markets, generally speaking, work very well until they catastrophically come off the rails.
When it comes to your world, your money, and your burning questions, prepare for answers from the leaders that know how to build empires, protect portfolios, and create the next big thing. This is Bloomberg Invest.
Please welcome to the stage Bloomberg's Sonali Basak.
Back for round two? Welcome, everybody. Thank you so much for being here. It is day two, of course, of Bloomberg Invest, the final day of Bloomberg Invest, and a huge lineup ahead of you. We're bringing together leaders in wealth, deals, sports, asset management, and, of course, some of the biggest deal makers of all time. Some conversations already taking place today, including with JP Morgan on our AI innovation stage. And of course, AI will still be a big theme today of how it's permeating businesses. And we are in the heart, of course, of the financial district here in New York City to deliver some of the most consequential conversations on asset management, wealth, and economies and markets. Some of the biggest names in finance today include private capital leaders Josh Harris of 26 North and Michael Arougheti of Ares. And, of course, deal makers Raymond, McGuire, Christina, Minnis of Goldman Sachs, and more. Before we get started, a couple of announcements. We would like to acknowledge first our presenting sponsors, Android, Invesco QQQ, Mass Mutual, and Mubadala. And our supporting sponsor, Principal Asset Management, and our participating sponsor, Southern Company. Very important, if you want to connect to Wi-Fi, you can find it on your badges and on the screens here as well. We'll be flashing this QR code throughout the day to participate in polls and submit your burning questions to our speakers. We like it when you have your phones out. Of course, we will engage you in our discussions today. We're going to start with our first poll. If you take out your phones now, scan this code, you'll toggle back and forth between the Q&A and polling. We're going to get you warmed up with the question, what is your outlook for deal making for the remainder of 2024? That M&A will pick up significantly. You expect activity to slow down. There's an election after all. Or it gets all done before the election. While you do that, I want to talk through a few more announcements. You can follow along today's coverage and engage in the conversation on major social media platforms under the hashtag Bloomberg Invest. Our handle is at Bloomberg Live on X, LinkedIn, and Instagram. And if you have a Bloomberg terminal, you can find today's conversation using the function Live Go. We will have the whole thing live streamed for you. We also have an event app. Use the QR code to download the Bizzabo app, and you can access our virtual networking community, chat with other people in the audience, build your agenda for the day, and more. Turn on those push notifications for reminders throughout the event. Now let's see where you have voted. Negative Nancy's out there. We have 56% of people expecting activity to slow down. That is some of what we've heard so far throughout. We have heard some optimism. About a third of you think it's going to be significant. Looking forward to seeing what our panelists also think about this today. All right, I'll see you back here in just a bit. Enjoy the start of the program.
Please welcome to the stage Josh Harris, founder of 26 North and managing partner of the Washington Commanders, with Bloomberg's Jason Kelly.
Well, good morning, everyone. Nice walk-on music, little pipe video for you. You know, like
this is real.
Real. Exactly. You know the vibe. So we have so much to talk about. First of all, thank you for being here. I guess I don't want to play too much This Is Your Life, but this is your sports life, maybe a little bit. 2011, you're a Penn alum. This little basketball team in Philadelphia comes up for sale. It's a couple $100 million. You buy it. Did you ever expect that you'd be sitting here today with the sports empire that you have?
Not my wildest dreams. Not my wildest dreams. I mean, the notion that I would own the Philadelphia 76ers, where I had gone to college, the New Jersey Devils, where my dad had grown up, and then obviously a whole lot of other, Crystal Palace in London, where I'd lived, and then obviously the Washington Commanders, where I spent my, I was 1 to 18 in Washington. I was 0 to 1 in Philly, and then I went back to Penn. So the notion I would own and really manage the two sports franchises that I'd grown up really passionate about was incredible. It's an incredible dream come true.
And so what did you see, other than, I believe you had been at Penn when the Sixers won a championship, is that right? Like, what did you see that was, from your investor perspective, that was compelling about sports then?
Yeah, so my personal journey was, obviously, I grew up with the Washington Commanders, the then Washington Commanders, but John Riggins, Joe Gibbs, 3 Super Bowls. And 1982, the Commanders won the Super Bowl. The then Redskins, everyone came out in the streets, and D.C. was a very divided city. I witnessed all that, and then went up to Penn and saw the Philadelphia 76ers win the NBA championship, and Philly was also a city that was kind of having trouble. So I witnessed everyone come out 2 ticker tape parades in 1 year when I was 17 to 18 years old, and it really dawned on me that sports really unified communities. And then, then sort of started Apollo, and then obviously got to the opportunity to achieve financial success. The financial crisis happened, and the Sixers, we had heard the Sixers might be not in Comcast's long-term future. And I literally just called them and went back to my day job of doing what's called a corporate carve-out, and I was zigging when other people were zagging. It was just after the financial crisis. The NBA was in lockout.
Right.
The Sixers were losing $40 or $50 million a year. And I paid $280 million for the Sixers. I put together a group. I called David Blitzer, my friend, and friendly competitor from Blackstone. And we had, known each other, gone to Penn, and we put together a group to buy the Sixers. I was quite nervous about turning it around, but we took them from 27th in the league in revenue to 5th, and so that's now a profitable entity. And so the idea there was more of a passionate thing where I wanted to really lift the city, connect with the city, bring the Sixers back. Obviously in business, which we're all used to, EBITDA, stock price, valuation, cash flow. In sports, it's about winning championships and creating memories, right? So that's why I originally got into sports. Obviously, the journey had started as more of a value-oriented journey, very similar to what I do at 26 North. The evolution is quite different.
Right.
As we go into the days today, we can talk about it, but obviously I just paid. At the time, I paid $6 billion for the Commanders, and that's 60 times EBITDA. And my credentials as a value investor were shattered, I joke. But the sports has changed a lot in that journey.
Yeah.
We could talk about that if you'd like.
Yeah, so I think you led me exactly where I wanted to go, which was that $6 billion figure, you're right, doesn't look like a value when you pencil it out. And yet, if you read the headlines today, or in the past month or so on Bloomberg and elsewhere, Jeffrey Lurie, your NFC East rival and neighboring franchise with the Philadelphia Eagles, selling a stake reportedly at a valuation of $7.5 billion. That I'm not that good at math, but that's 25% more than the valuation you paid. $10 billion is the number that Stephen Ross is talking about, again, reportedly, for the Dolphins and associated properties. That's a huge jump. What is driving these valuations, and how much higher can they go?
Right. So if you look at the evolution of sports content, right, particularly the big sports, the NFL and the NBA leading the way, there's a massive globalization of content because of the ability of people to stream content and watch it on their phone. So in many cases, there are more people watching the Sixers in China than there are in Philly. And that's the case all over the world. And so you're seeing, and then live content, right? All of us have witnessed the Taylor Swift phenomena. And, you know, obviously I just found out that the Angel Reese Caitlin Clark, audience was by far the biggest ever in the NBA, the NHL finals, massive audience. 42 million people watched the Dallas-Washington game this Thanksgiving. And so this ability to, become part of a community watching a team live win, that's really lifting sports content. And so you're seeing massive upward pressure on valuations as more and more eyeballs and more people really engage in it. It's become very important to the media ecosystem. So if you think about the NFL, the Bills in 2013, $1.4 billion. Panthers, 4 years later, 2.3. Denver, a couple years ago, 4.6. Commanders, 6. I mean, that's been the arc. In the last decade, you had a 4X. I mean, obviously, it's rumored, or maybe even be inked, that the Nets just sold a minority stake for $6 billion. And their Forbes value, which is how people kind of think about it, at least as a starting point, was was in the threes. So right. You see and that part of that is that the NBA deal, right, is rumored, and I don't want to get ahead of the league, but it's rumored and in the press that it's going to be more than 2x the last deal. So that'll take the NBA from a league that was making some cash flow and growing to a league that's making a lot more cash flow that's achieving substantial growth. So you have all that, plus you have, the entrance of private capital into sports. Mike Arougheti's on next, Ares, Arctos, Dial, and that's also expanding. You see, certainly some sovereign wealth funds owning teams in Washington. So increasingly, you're just seeing a lot of upward pressure, and it starts with, the communities themselves. There's been a breakdown of community, right? It used to be that we lived in small towns, everyone's moved to cities. So what are the things that really bring people together? And sports is really a unique proposition. It brings people together. So it's very exciting for me to be a part of it. And, look, I feel a great sense of obligation to win, right? And because I know what that does to a city.
Yeah.
Anyway.
So is there a ceiling at this point? I mean, where does it go from here? I mean, you're a very smart, successful investor. You have to look at this and at least pencil out where this could go.
Yeah, I think that you've seen pretty long-term trends of Forbes value and enterprise values going up in the 10 to 16% range. So if you look at the valuations over the last decade or so, or even over the last 20 years. I mean, again, people talk about my experience in deal making at Apollo and Lyondell and all these things, but at the end of the day, the Sixers, right? The Forbes value on the Sixers is, between $4 and $5 billion. So you think about the acquisition that we made there, it's an amazing deal for us, and that's all being driven by the media content increasing and these becoming entertainment businesses and not local event businesses. And I would expect that to continue. When you see, if the rumors about the NBA are true and it's going to double over the next, 8, 9, 10 years, obviously you can do the math. That's 10 to 15% growth rate TV. There's a little bit of leverage there. So you kind of you can pencil out. I mean, when we put together this group in the Commanders, we had to make our case, and you kind of pencil out low to mid-teens, right? And it's not a private equity return, but I really like it as part of my own portfolio because it's correlated. doesn't really go up and down with the economy. A lot of it's driven by, you know, the growth in the streaming content and technology. It's a growth equity business almost. And then it goes, it's generally trending up. There's a scarcity value. Sports teams are obviously operating businesses and they generate cash flow. Some of them don't. A lot of them do. But then it's also kind of a piece of art, right? There's only 30 or 20, depending on the league, or 32 of these franchises, and you know, people want them, right?
Right.
So at the end of the day, it's like it's worth whatever someone will pay for it, right? So there's an element of a little bit of a Basquiat there or beachfront real estate. So you got to kind of think about all that, but all of it really says to me that it's going to go up. I mean, interest rates have gone up, right? So you would think that sports would go down, but it hasn't really slowed it down at all because the media growth has overwhelmed it.
And so with that in mind, you went to, you know, put together this group for the Commanders, a fascinating group of people, Magic Johnson, your partner David Blitzer, and others, Mark Ein, who I believe was a childhood friend of yours.
Second grade friend.
And that's a good second grade friend to have, you.
Mitch Rails.
Yeah, there you go. So when you think about that, you know how hard it was to sort of circle all that up. You are in an increasingly small number of people who can write that initial check and circle that up. Private equity is reportedly coming into the NFL. Private equity has been, institutional funds have been in the NBA. You've been a witness to that. Does that, what's the effect that institutional capital coming into a league like the NFL have?
Yeah, so all that's going to have upward pressure on valuations because if you think about the NFL, so the NFL, in my opinion, generates a lot more cash flow than really any other league. And so it's one of this very small number of sports where you're not really using a multiple revenue. You can also use a cap rate, right? There's enough cash. So the average NFL team makes, you know, $100 million of cash flow, right? So there's a cap rate there. It's not a high cap rate, but I think that private equity coming in will obviously enlarge the capital base that's focused on investing in sports. Institutional capital, and it'll just create upward pressure. What happened in the Commanders deal is that it was a $5 billion equity check. So even for someone like myself, that takes you from not only do you have to be in the Forbes 400, you have to be in the Forbes 40, right? There are only a very small number of families that can afford that. And so obviously the Waltons, you know, I had bid on the Denver Broncos. The Waltons came and topped me, right? And I had to create a group, and they didn't, right? And so the smaller and smaller, the bigger and bigger the size, the equity check was limiting more and more the size of the individuals that could do it. And I think the NFL is intelligently saying, well, let's take a look at that because even though we're incredibly scarce content and people want to be part of this, we need to open it up to allow for valuations to continue. So the constraining part of the Commanders deal, and the reason that we were able to get it, was that you didn't have a massive individual or family show up, and then no one else could raise the capital because the NFL rules are very restrictive on governance, on control, on exit, and so we had to round up a whole series of investors, some of the people that you mentioned that would trust us, that we would be good stewards for the franchise, that we would be good stewards for their capital. And you know, raising $3 billion is a lot of work, right?
Right.
And so the fact that I had been in the investor community, managed capital, but also been in sports, made me uniquely positioned to raise that capital, and no one else could do it. So it wasn't the value that I paid, it was the ability to raise the capital that got that deal. And that kind of whole process, I think, has focused the NFL on, okay, hey, how do we make this a little bit easier on everyone?
Right. I want to pivot slightly because, and this is actually something that came up backstage when we were talking with Mike Arougheti, who is, I'm sure you're going to hear this more from Shonali and him, you know, a minority owner of the Orioles. He's in business with Cal Ripken, and I pointed out, you're also in business with Cal Ripken in youth sports. That, I would imagine, knowing a little bit about this crowd, that there are a lot of parents of young athletes in this crowd. Tell us about that business. What's the business case for youth sports? Because you guys, you and David Blitzer together, personally, have gone in a pretty big way there.
Yeah, so what we've done is we created this business, Unrivaled Sports, and we did it, for us it was like an economic project and a passion project because, you know, all of us, you know, obviously we are fortunate in this room, and we all love sports. I love sports. Sports changed my life. I was a college wrestler. If I hadn't gone through the experience of, having to go out there and literally be physically dominated by another human being, I probably wouldn't have worked as hard as I did in my youth and, turned my life around. And I've learned a lot from it.
You have wrestled Wall Street to the ground.
There we go. I love that. I'm going to use that. I'm going to use that. Look, I think we want the opportunity to have everyone's kids to be able to experience that no matter where they're coming from. So Unrivaled is a series of youth sports leagues, camps. It spans baseball with Cal Ripken and a series of other individuals to Shaun White in adventure sports. Most recently, we're in flag football, which is obviously very exciting. And we touch over 1.3 million kids. And you've got the people in this room that can pay a lot of money, and people pay a lot of money to send their kids to get better at sports. If you're a youth baseball player, you can go to the Hall of Fame Cooperstown Baseball, right, where we own the land and the fields. Like, that's an incredible experience for the summer, and people spend their whole year thinking about that, and it's expensive. But on the other hand, you can also invite people and teams and clubs that can't afford it. And so it's one of those unique things where it's incredibly profitable, but it's also incredibly good for the world and a positive thing. And so we're attracting all these incredible people to do it. It's growing like crazy. Andy Campion, who was the COO and the CFO of Nike, who had many, many other offers. This is a emerging company, but it's still pretty small. Said, no, I want to do this because this can be a massive company, and it sort of is hitting on what people want to spend their time doing and thinking about, particularly women's sports.
Yeah.
Which we can talk about, but it's a lot of the participants, certainly in flag football, are girls and women. And
so, what gives you see the landscape probably more holistically than almost anyone. You've got the EPL, you've got NFL, you've got, we've talked about all the different holdings you have. The valuation's going up. This is a great business. And yet, you're a smart investor. You're looking around the corner. What gives you pause? Like, what sort of worries you a little bit about this broader sports as an asset class market?
Yeah, I think if you think about sports, right, the big 5 or 6 sports, the NFL, the NBA, the Premier League, UEFA, so the Champions League, and then the NHL, those are all like global media businesses, right? They're not live entertainment businesses. I'd say the rest of the world, and those, the reason that people want to watch those sports, I mean, maybe Indian cricket, which I'm not as familiar with, the best players in the world come to those sports, and even the Premier League is even starting to, dwarf some of the other national leagues, right? Because the media dollars are so big. So more and more of those sports are going to attract, the kind of global audiences and continue to grow. Obviously, in certain sports, you've seen live golf. You've seen, some nation states kind of try to come into those sports. I think it's pretty hard, to be honest with you. That would be one thing that, we just have to keep our eye on. And the other thing would just be, obviously, anytime you see, as a value investor, anytime you see substantial growth in valuation, you always kind of look at that. But I do think I don't really see it slowing down. And for me personally, this is, these are long-term assets. They're going to be in our family hopefully for generations. My daughter's in the audience.
I was going to say your daughter's here. I saw the future.
It's really more of a long-term and passionate thing for our family where, our job is to win for the cities and create memories. And the financial part of it has been exceptional, and I do think it will keep going up. And I've been lucky to be early because the price is going up on all these sports. But, I'm not really as focused, year in, year out on the valuations other than intellectually and other than as I buy new things.
Right. Just have a couple minutes left. I would be delinquent in my duties if in front of this crowd I didn't ask how this is affecting your day job, although it feels like you have about 6 day jobs. But, you started this new firm, 26 North, in your sort of post-Apollo chapter. I have to think what you've done in sports has some impact, whether it's emotional or analytical or whatever it is, how do they inform each other, and specifically, how does sports inform 26 North?
Yeah, so 26 North has been a hugely exciting thing. I mean, obviously, I left Apollo 31 years and took a year off. That didn't work for me. I don't like golf. I don't like tennis. I like to work. I like to create ecosystems of amazing people that are excellent. And then, my passion was always to be an investor, so I went back to it. And we created a big firm ecosystem against a middle market amount of capital, a lot of alignment. Most of my capital is in sports for 26 North, and then everyone who joins, we're getting amazing people. They're all leaving huge jobs to get paid a lot less cash and own part of the investor returns, which is different. So it's at $22 billion now. I think sports is incredibly in 20 months, which has been humbling to see the success of the company. But sports, I think sports is in sports. It's not just about money. It's about impact. Like, how do you create memories, right? How do you make cities happy? So that stewardship, right? In finance, we're working to create retirement savings for millions of beneficiaries. So they're similar, but I think what I do in sports, a lot of it is culture and people. Mm-hmm. And in finance, a lot of it is culture and people. This notion that it's not just about money, that alternatives is about creating a better world for millions of beneficiaries that are frontline workers, teachers, firemen, that if you can kind of bring a little bit of that impact part of it into finance, you attract incredible talent, like making it about more than just money and making it about impact and really focusing on culture. I've learned a lot of that from sports, and so I brought a bunch of that over to 26 North. And what it does, it allows me to, obviously in investing, it's all about returns. Yeah. At the end of the day, you live and die by your numbers, but you create those numbers by having great people. And so having this impact part and this kind of greater vision, I think, gets us great talent.
All right. Unfortunately, we have to leave it there. Thank you so much.
0.00 on the clock. We
nailed it.
We hit a 3 at the end.
All right. Good luck in all your seasons. Thank you, everyone. Thanks.
Strategy to win long-term in private markets is origination and investment acumen.
Please welcome to the stage Michael Arougheti, co-founder, CEO, and president of Ares Management with Bloomberg's Sonali Basak.
Thanks for joining today.
Great to be here. Thanks.
I know you can talk about sports a whole lot as well, but we are going to force you into the topic du jour, which is credit.
Oh, boy. Sports is so much more fun than credit, I think, right now. Okay.
So credit has been fun, actually, this year for a while, and you're at the epicenter of one of the hottest markets, of course, private credit. I don't think people realize how fast you've grown in such a short amount of time and even bigger goals ahead. Yeah. Let's start with the environment. This higher interest rate environment on the precipice of maybe a rate cut this year, how it impacts the way that you're thinking about investing.
I think one of the reasons why people are drawn to private credit, aside from the fact that it's had durable performance for a very long time and it's a growing market, is most private credit instruments are floating rate. So almost perversely, the higher rates go and the longer they stay high, the better the return performance, right? So clearly, a lot of capital is being just drawn to the IRR opportunity. On the flip side, as rates stay high, it contracts the deal environment. And so there's always this tension or balance between wanting to see the deal machine turn on to drive velocity of capital versus benefiting from high rates. And we're kind of getting to a sweet spot right now. I think now that rates have stabilized and that cuts are on the horizon, we are seeing the pipeline pick up meaningfully, which means you should start to see more deals, more velocity, And even if the base rate comes down, it's still going to offer a pretty attractive rate.
Let's talk more about that. What was interesting is we spoke to the audience a little earlier. We put up a poll, and more than half of the audience believes that deals will meaningfully slow down. And so what are the signs of a pickup? How meaningful could that pickup be?
Well, half the people thought deals were going to slow.
Right.
Interesting. I think in the private markets, what really drives flow is the weight of capital, is the way that I think about it. I mean, most institutional equity that supports the private deal environment has a time limit on it, 3 to 5 years to invest. And obviously, you're always trying to find the right opportunity to invest where you can benefit from earnings or cash flow growth and capture multiple expansion. We're in this time now where people have been on the sidelines for quite some time. Investors are clamoring to get capital back. So that creates some tension for people to start to monetize performing companies. And as the dry powder ages, there's also a catalyst for deal opportunities. So I can only say in our pipelines, we're seeing a meaningful acceleration in deal flow. So I would actually take the other side of the
trade.
50%.
So what do you think about this condition private equity is in? There's been so much talk about this liquidity crunch investors are feeling. How much of that is being satisfied in the credit markets through kind of more esoteric financings we're seeing out there?
It's real. I mean, this DPI issue is absolutely real. It has not resolved itself. If you look at private equity just as one piece of the institutional equity market, there are 3 times as many dollars invested than uninvested, right? So you have about $3.5 trillion in the ground that needs to get resolved versus about $1.5 trillion that's wanting to be invested. So if you're a private equity manager, you're trying to decide, do I take my capital and put it into my existing portfolio to either defend what I own or to try to grow it and create more value? Or do I use some, to your point, some creative financing to extend the duration or the runway of what I own and then try to put the capital into the new market environment? And everyone's taking a different approach. It's a function of where you are in your life cycle, what the prospects for your fundraising are based on returns, but everyone is dealing with that. Even the highest performing PE firms, you're seeing slower fundraising, and in this deal environment, you have to start thinking creatively about how to get liquidity back to your investors. So secondaries, continuation funds, minority sales, private credit, refinancings, all of those things are on the table.
How exciting is, for you, the private equity versus private credit opportunity these days?
It's funny. I view it all as one spectrum, and I think this is why maybe private credit is growing and getting the attention that it is. Any asset that we invest in, whether it's a company or a piece of real estate, has an unlevered free cash flow associated with it. And as the markets evolve and we innovate, it's really just a question of where do you want to attach to that asset. And in most markets, at the very early stage, sports being one, as Josh and Jason were just talking about, capital structures are pretty simplistic, right? Banks, equity, or banks, high net worth individuals. And as the markets grow and evolve, we all get quite creative and innovative of trying to figure out where we want to attach. And so, private credit, growth in private credit is in fact an extension of people's positive experience in private equity. We're able to go deeper into some of these assets at higher rates of return with more creative structures, but we have capped upside in a lot of these, right? So in some of our opportunistic credit mandates, we're actually creating debt-like instruments that have equity upside. But private equity is critically important for the investor community because it is the only place where you can go get 2 to 3 times your money. So private credit, durable, high current yield, performs through most market cycles, but at the end of the day, your return is going to be pretty range-bound, if not capped.
Now, it was interesting. A day ago, we had a boatload of debate on this stage about private credit risks, opportunities, cracks in the market. So let's hear it from you. Where do you believe cracks are, if there are any?
We're not seeing a lot of cracks. I've been in the private credit market for almost 30 years, and there's a constant and consistent narrative that there's risk being taken in private credit that somehow is going to, topple the economy or create systemic issues. Back to my earlier comment, people need to appreciate most private credit instruments that we're all talking about are backed by some form of institutional equity ownership. And most private credit instruments are levered 50 to 60% of enterprise value. So if people are really anxious about losses industry-wide in private credit, you're blowing through trillions of dollars of value in the institutional private equity, real estate, and infrastructure market. So people need to zoom out and kind of understand again where these loans sit, who they're supporting, and the types of investments. That's one. Two, we have close to 4,000 middle market investments at Ares, and the credit performance has been incredibly strong. Default rates are low, interest coverage is healthy, EBITDA is growing in the low double-digit range. So yeah, we feel pretty good about it. I think it's all a little overblown, to be honest.
So another part of the market that I did not get to ask some of our guests about yesterday that you do very much operate in is real estate. Mm-hmm. How much stress is there still in that market right now?
Well, there's more stress there than there is in the corporate market, I think for maybe obvious reasons. One, the asset class runs more leveraged, so it's a little bit more rate sensitive. Two, the maturity wall issue in real estate is probably more acute than in corporate. The reason being there are just fewer levers to pull to effectively restructure or rehabilitate a piece of real estate. So when you think about maturity wall or even modestly underperforming corporate investments, you have levers to pull both on the balance sheet and the income statement to try to grow through it. You own a building, it's leased or it's not leased, the rent covers your debt service or it doesn't, and that's basically it. So the math of the asset class clearly sets up just for more acute stress. That said, when you put office in certain markets off to the side, we are still seeing pockets of strength in multifamily and industrial, which is where we're largely invested. So I think that story will still play out, but I don't think it's going to be a big systemic story. I think it's going to be one that kind of grinds its way out over time.
Whether it's the corporate market that might look to refinance or really restructure to kind of stave off the higher interest rate environment, or if it's real estate where you're seeing private market values really start to bottom in some people's perspective, how much money do you put to work? How big of an opportunity do you see?
As a private market investor, you can't try to perfectly time markets. That's the good news and the bad news, right? You have to be directionally accurate. We get the luxury of not having to pay attention to all of the headline, and volatility that can induce. But the best time to invest, both corporate and real assets, is when you think you're coming out of a cycle. So in real estate in particular, this is a great time to be forming capital, planting seeds, because you want to get out ahead of it. And that's our experience, in multiple cycles. So, it's a pretty good deployment environment. And like I said, we are seeing the pipelines pick up, which is encouraging.
It's interesting. In addition to just deploying for your funds, we reported here at Bloomberg that you're also considering one of the largest private asset manager deals of all time, or at least we've seen in recent years in the real estate world. What can you say about your M&A ambitions of your own?
Well, not to speak about rumors specifically, we've been quite acquisitive, as you know. So if you look at our growth, 20% of our growth over time has come from some kind of M&A. I have a very strong view that these markets will continue to consolidate. And the reason that they're going to consolidate is, from the manager's perspective, there's huge benefit to scale. Right? The larger we get, the more people we can have. The more people we have, the more deals we can do. The more deals we do, the more information we get. The better information we get, the better our investment performance, and then we get more AUM. And so there's this virtuous circle and cycle that scale creates in private markets, and people are beginning to see that. Investors are putting more of their dollars with fewer managers because they see that opportunity for outperformance, and they also see a huge efficiency. So most large institutional investors you talk to will tell you that they're shrinking their investor roster from, call it 100 to maybe 20 managers to try to drive efficiency and deeper partnership. And the markets are global and globalizing. So a lot of the things that we learned, let's say, over our 25 years here, we can now apply into developing markets like Europe or Asia that are earlier on in their maturity curve. So we will continue to be at the forefront on the consolidation. We want to be a consolidator, not a consolidatee. I think we have a really good track record of buying companies financially accretive, strategically accretive, and obviously driving culture, which I think is important. But we're not alone. So I would expect to see a lot a lot of activity, particularly once you start to see rates come down and capital start to move.
Safe to say you'd be looking for large prey.
Well, it's all relative, right? So what was large 10 years ago isn't quite so large now. So, with a market cap that's $40 to $45 billion, we can actually do some pretty transformational things in large markets while making sure that we're managing the right risk.
So let's talk a little bit about another growth area for you, which is wealth. And there have been a lot of questions in this market. A lot of asset managers trying to make their private asset management business more amenable to the retail channel. How do you do that? You've seen some very high-profile examples of jitters in the markets. Starwood, for example, limiting redemptions for investors. How do you navigate an environment like
it's a good question, and maybe I'll just talk philosophically, and then we can talk specifically about how you do it. I'm a big believer in the importance of democratizing access to alternatives. For decades and decades, the world of alternatives was really only available to institutions, and so yes, individuals were able to access it, but it was indirectly as a beneficiary in a pension fund. And so the opportunity for them with a sophisticated advisor and a sophisticated investment manager to get access to some of these outcomes, I think is critically important. So big believer that it needs to happen, and big believer that it will continue to grow just because I think the advisor community sees value in it. The difficulty is, which is where I think you're raising the question, is the retail investor doesn't always behave with the same level of patience and long-termism that the institutional investor does. And so a lot of these structures that we've created are designed to give adequate and appropriate liquidity, but not necessarily function with daily liquidity the way that the retail investor is used to accessing the markets. And we view that as a huge benefit, right? Because again, having managed, for example, ARCC, which is the largest traded BDC, sometimes the best time to be investing money, as we talked about coming out of a cycle, is when people are looking for liquidity. And so you're constantly going to be trying to balance your capital base and the deployment opportunity. And then lastly, I think the challenge that this market presents is in alternatives. Historically, we've invested out of drawdown funds where we can create alpha simply by not investing. So one of the ways that we outperform over time is to actually hold back, sit on cash, and then deploy when we see a better deployment opportunity. When you are managing continuously offered product, you get $1, you put $1 into the market, and that starts to function, in a way that is antithetical to the way that you generate alpha in private markets. So we've gone slowly in scaling those because we want to get the diversification that it provides. We want to provide the outcomes to the investor, but we don't want to inherit that, the weight of the money coming in when we don't think it's right to deploy. That said, we're one of the top fundraisers and managers in the space because most of the large wirehouse platforms, RIAs, and IBDs want access to top quality alternative product. We have a wealth distribution capability with about 150 people around the globe. We have 8 products in the channel, all of which are scaling quite nicely. And so now, similar to an institutional investor, a retail investor can largely access our real estate, private equity, private credit, and infrastructure capability in some format in the non-traded market as well.
We are going to switch to sports, too.
Okay.
Because that's the fun stuff. It's also the place we're getting a lot of questions from the audience as well. And, of course, that's both through Ares' own involvement. And, of course, you are a part owner of the Baltimore Orioles. And so if you think about sports, how much investor interest can you draw? We have reported that you are one of the firms close to the NFL process as well. What does this mean for the amount of money that can come into different leagues?
Well, I hinted at it earlier, so maybe I'll repeat it. That this is a new asset class, right? So if you think about the structure of the sports landscape, just teams and leagues, putting aside stadium redevelopment projects and media rights securitizations and youth sports and all of the things that, right? So this is a huge ecosystem of assets. But if you just go to the team and league level, up until COVID, the structure of the market was pretty simplistic. It was bank capital and rich people. And those two sources of capital were able to support a pretty compelling, growth in value in these assets for a very long time. When COVID hit, 2 things happened. Number one, you had a lot of owners of teams that had generational wealth that got created through the ownership that were asset rich and cash poor, and all of a sudden had a business model where they were struggling to actually support the asset. So that caused a lot of the team owners and leagues to start thinking about the importance of some other form of creative capital to come into the market. And that really is when we leaned in at Ares to start building in earnest what is now a pretty large sports investment franchise. And then the second thing is, coming out of COVID, I think everybody relearned how important live content is and how much we all enjoy going to sporting events and how much time we spend watching it on TV. And so you saw this re-acceleration in the value of global media rights for sports teams and sports leagues, which started to accelerate values again. So now you had a secondary problem, which was, now that we've kind of healed through COVID, in a world where you're trying to grow your franchise value 10 to 15% per year compounding, how do I support that? There's just not enough bank capital or high net worth individuals that love sport that can actually drive those values. So a lot of the leagues and teams are now starting to think about institutional capital as a critical component of, you know, the growth in these franchises. If you just think about the, you know, you mentioned the NFL, and not to hone in on that, but if you just take the equity value of the teams in those leagues, you know, you're talking, you know, tens and tens of billions of dollars of investable opportunity that didn't exist before.
What's the NFL math?
Well, I mean, take your number of teams and multiply it by 5. So there's $100+ billion of franchise value that needs to get supported by some form of institutional capital over time. Baseball, you have 30 teams with probably an average franchise value, you know, in the mid-2s. So that's $70 billion of asset value, and so on and so forth. And so each league is going to be different in terms of where they are in their media positioning, what kind of flexibility they're willing to accept or not accept. But institutional capital is going to be a critical component in continuing to evolve the.
You think about the Mark Lazard comment last year about the NBA. Valuations feel toppy, so I'm getting into pickleball instead. How do you feel about that? Are valuations getting toppy? Do you look for places where maybe there's more of a runway, like women's sports?
Well, we've been a big supporter of women's sports. We helped to launch a professional women's volleyball league through our sports franchise. We've been supporting the growth in women's soccer. I don't think you have to choose one. I don't think that valuations are getting toppy. The reason that folks are drawn to investing, at least in the large leagues, is scarcity value. There's a complete lack of correlation from anything else that you can invest in. So you can go back 15, 20 years and map the growth in sports franchise values against traded fixed income, public equities, private equity, zero correlation for the most part. So that's of significant value. So I don't think you have to choose. The upstart leagues or the challenger leagues or some of the things like youth sports, women's sports, pickleball, cornhole. I mean, there's an endless set of things that you can invest in, and they all have value, right? Like in anything we do, they're going to be on a different growth trajectory with a different set of risks and a different set of opportunities. But I think it's all getting to the same point, which is we spend a lot of time globally consuming sports content, whether it's pickleball or the NFL. Like, that is a big part of the human experience. We all emotionally attach to it. Most people are passionate about some part of the sports ecosystem, and now the opportunity to actually tap into that through investment is going to be another, accelerant, just because people want to be a part of it.
Quite the business idea for the world's cornhole champion. Michael, thank you so very much for your time today. Can have enough time with you ever. Thank you.
Thank you. Appreciate it. Thanks, guys.
Please welcome to the stage Vaughn Bowman, Head of Wealth Management at MassMutual, with Bloomberg's Michelle Lynn.
Global Head of Data Science and Insight for the Bloomberg Media Organization. And I am joined by Vaughn Bowman, Head of Wealth Management for MassMutual, for the MassMutual Sponsor Spotlight, Get Ahead with Estate Planning. Vaughn, thank you so much for being with us here today.
Thank you, Michelle. It's a pleasure to be here.
Great. Okay, let's jump right in. Why don't you tell us about the MassMutual mission and estate planning and the opportunity that's guiding you?
Sure. I will say first off, there has never been a more complex environment for our clients and for their financial needs across the industry. They have to navigate a jungle of changing tax laws, new and innovative investment strategies, and economic uncertainty. And sadly, a lot of clients just don't have, let alone an estate plan. They actually don't even have a financial plan to be able to position themselves and their families to be able to navigate this complexity. That's why for me and for all my colleagues at MassMutual, we're incredibly passionate about being able to support our 7,000 financial advisors on this journey and help them provide the support that they need for their clients. Some people may not realize it as I talk to them, but MassMutual, in addition to having a 173-year track record and pedigree in the life insurance space, we've actually been in the wealth management industry, in the wealth management business, for over 40 years. And with $250 billion in client assets under management, we're really well positioned to help advisors and their clients on the journey ahead.
So what does this mean for advisors?
So what I would say, if you're a financial advisor, it is fantastic if you're helping your clients with asset allocation. It's fantastic if you're helping your clients picking the right investment strategies. But what I will say is, if you're not also talking to your clients about the expiration of the Tax Cuts and Jobs Act, if you're not also talking to them about the right way to position their assets in trusts, the right way to structure their wealth, if you're not also talking to them about all these interesting things that are innovations that are happening in the marketplace about how to protect that wealth in the generations to come, then I would say either one of two things is happening. Either your client is being underserved, or they're getting that advice somewhere else. And either one is not a great outcome.
Tell us about an opportunity that advisors can enact today.
So get ready for it. I'm going to give you the most sophisticated piece of advice that you're going to hear at the entire Bloomberg Invest. It's maybe technical, maybe tough to understand, but bear with me, okay? Find the smartest person you know in trusts and estates and take them out to a really nice dinner. That's my advice for advisors. You know, one of those places where you have to order the side dishes separately, that nice. And listen, simply listen. This has worked for me over the years. Chances are you're going to hear many stories from those experts in how to structure and position your clients' wealth that are going to resonate with your clients, and it'll give you the opportunity to serve them even better. And I would say, as you build out that network as an advisor, it kind of becomes a SWAT team where you can call in the experts when something changes in tax law, when your client's circumstances, whether in life or professionally, change. You then have those folks at your fingertips and you can call them in for help, and you don't have to be the expert on everything. And I would say, remember the fact that your clients trusted you, they still trust you to navigate through that jungle that we talked about. And if you have all the right experts on call, you're going to do just fine.
Great advice. Any final takeaways you want to leave us with?
You know, Michelle, we had a fantastic panel this morning. We talked about the great generational wealth transfer. We had heard from some great experts. The one thing I would leave you with is, in addition to the fact that $84 trillion in client wealth is transitioning over the next 20 years, I would argue there's also going to be, equally importantly, a transition taking place to advisors that are well positioned with the will and the skill to help their clients on this journey, and from those advisors who are simply not ready. And the question for all of us in this industry is, which one of those do you want to be?
Vaughn, thank you so much for being here with us for the MassMutual Sponsor Spotlight and discussing estate planning with us.
Thank you.
At MassMutual, our commitment to wealth management means offering financial advisors the best of both worlds. With our innovative supported independence model, we're giving you freedom with resources you need to run your business, helping you make a name for yourself with our good name behind you, freeing you to offer clients the advice they need, and making sure you're properly compensated for that advice. When it comes to wealth management, we choose to lead.
Please welcome to the stage Christina Minnis, Head of Global Credit Finance and Acquisition Finance at Goldman Sachs, and Mark Jenkins, Head of Global Credit at Carlyle with Bloomberg's Danny Berger.
Everyone, thank you so much for joining us for this panel. I am really excited because we have two experts, and we're really going to dive into the health and the idiosyncrasies of this debt market and where we stand in this very moment. So, Christina, thank you so much for joining today.
Thank you. Great to be here.
Christina, I want to start you with this. Last month, $160 billion of leveraged loans priced. That is easily a record. It's Bloomberg data going back to 2013. Given that, how would you characterize the activity and health of these debt markets right now?
It's in really fantastic shape. Right now in market, I think we have $45 billion trying to come through this week or next week. And so it's been incredibly busy. And, we feel really good about the forward. The technicals are set up fantastically because many of these transactions that are coming through are not new money. And so when a new money deal comes through, it gets a tremendous amount of attention. And quite frankly, all the deals seem to be working. There's a little bit, I'll call it a slight indigestion that we've seen in the last probably 10 days. And one barometer that I know Mark and our firm take a close look at is what's the percentage of loans trading at par or above? And that was in the mid-60s, and now it's in the mid-40s. Still fantastic compared to where we were. But there's a little bit of, I'll call it, indigestion in the market right now. But in general, we feel really good about the health of what we call the BSL market, the broadly syndicated loan market.
Do you share that optimism?
Yeah, I mean, look, we went through famine last year, and now we're in feast. And I say, we see the other side of it is we're one of the largest CLO managers in the world. And so we've been as active in the past 6 months in terms of forming new CLOs as we were at the height of late 21, 22, which was our best year ever. So I think, that is helping fuel the 70% of the leveraged loan market is consumed by CLOs, so we're seeing the benefit of that. But we're also seeing a very dramatic tightening in spreads over that same period of time.
I mean, but Christina, to your point, I mean, there was a glimmer of spread widenings, and then it quickly snapped back to normal. But amid all of that, there's this hope that deal activity is here and that this is a sign it's back and it's going to be back in full force. Is that what you see going forward?
Well, if we look at a couple of statistics, M&A is up year over year roughly 19%. And that is still way off the averages over the last 5 years, right? So that's a good dynamic. It's up. And within that dynamic, you see some real outliers, like a TMT is up almost 80%, FIG's up 45%, and then industrials, CME, and CRG are up sort of in the 30s. Really good technicals, but they're off a very, very low base. I think, what is exciting for us at Goldman, because we have a great lens into the M&A market, being number one in that market, is we have something called conflict checks, which is the number of firms, private equity firms, that are calling into us to ask, can you work with us? And we see that ticking up, which is just a nice barometer. And then I would say the number of sell-side processes that we have launched in the last few months is up. And in addition, we see corporates being much more active. One statistic we keep an eye on is what we call corporate reclassifications or, selling of divisions or, deconsolidations. And that is up year over year as well. So I think we feel like there's a setup, and I heard, the panelist right before us saying that he's also cautiously optimistic. Yeah. Now, will a tremendous amount of M&A buyer to seller get done because they meet in the middle on value? Maybe not. But for the credit markets, you still have a lot of options, whether it's a recap, a minority sale, and that's what we're seeing. So it may not be asset sale outright, but a transaction's going to occur.
I wonder if this idea it's not asset sales outright, and that a lot of them aren't new money. It's not new deals coming into the market. yes, it's healthy, but if there's some frustration for you, Mark, in this market at all?
Yeah, I don't know if I'd call it frustration. I would say, I think we came into 24 thinking it's going to be, compared to the past 4 years, a pretty boring market. And in some ways it has been, right? Not a lot of volatility. But I would say we also came in with the optimism that Christina's talked about, which is, nothing happened in 2023. Actually, in fact, corporate credits got slightly better in terms of leverage. They stewarded their cash very well. They became more productive. I mean, we look at our numbers in the over 800 credits that we cover across our platform, and actually, revenue has actually been, sort of slightly flat to down, but EBITDA has been up. And so how do you account for that? Well, people are adjusting to this higher rate environment, much better, productivity. Clearly AI hasn't impacted them yet, so it has to be something else. And as a result of that, we thought, okay, well, there'll be more M&A activity. Well, it's slow to start. And I think what Christina's talking about is what we're seeing in our private equity portfolios as well, is those processes are beginning.
Right.
But I think the key concern we have is, will there be activity where the buyers and sellers meet in the middle? And that hasn't quite happened yet, but I'm hopeful it will. But when you look at the market overall, this year in the leveraged loan market, over 25% of it has repriced, right? And so that's a lot of the activity you're seeing. And we are seeing, dividend activity, repricing, recaps, et cetera. But we want to see healthy M&A acquisition activity happening, and that's what we're looking for.
Sir, go ahead.
One thing I should add, which is super exciting for someone that's been in the markets as long as we have. We used to work together a long time ago.
We've known each other for 30 years. So.
Yeah, it's a long time.
You met when you were 1 year old. Yes.
Growing up in this business, it was really, really hard to get take privates done. Boards didn't want to transact. There was always a reason why not. Take private activity is up demonstrably. Year to date, we're at $195 billion versus last year, I think $125 billion. It's the second highest year since we've been keeping an eye on what we call P2Ps. And that's super interesting. I mean, those are deals that historically have been really hard to get done. But there's efficiency in markets. You see a market value of your equity trading, and so you throw a premium on that, and you can look at the 52-week history of the stock price, and the board can get their head around, and a firm like Goldman can write a fairness opinion. The challenge that we have in private equity is we have this thing called, where are you valuing, where are you marking your portfolio to market? And there's been a lot of discussions about that. But if a portfolio is marked, I'll use an example recently of one I know in particular, marked at 22 times EBITDA, and the bid comes in at 14 times EBITDA, even though it's a very full and fair bid, the PE firm may say, you know what, I'm just going to kick the can. I'm going to wait and hope. Right?
Yeah.
But that's why I think the really interesting dynamic right now is the activity around take privates, both in Europe and the U.S. It's pretty extraordinary.
Yeah. But this sort of idea of kicking the can down the road, the credit market has been criticized for this too, that there's some aspect of just extend and pretend. Would you find value in that criticism? Is that right?
It's a criticism for sure. I don't know if I find value in it, but what I would say perhaps is what's happened is these companies, think about the period of time from the late 2021, 22 period, where there's a massive amount of M&A activity occurred. Frankly, in the highest multiple environment with zero rates. Those companies generally, because we can't cast a net across everything, those companies generally have capital structures that after the Fed's increased rates 2,900% actually don't work very well. And so there is an element of those companies in particular where they're trying to get to the other side, where people like us can provide capital that allows them to reinvest cash flow into the business. And I think that's not really pretending and extending. I think that is more of just helping them get to the other side while they earn their way out of their issue, if you will. The companies that you're talking about that we pretended and extended, that was a result of coming out of the GFC, where we held rates at zero, basically, in real and nominal rates for over 14 years. And there was a number of companies through that period of time that probably shouldn't have existed, but existed purely because, to your point, we could continue to recapitalize them at a zero-rate environment. What's happened is, really through 22, 24, or 23, as rates went up, a lot of those companies are gone. They restructured, they defaulted. Defaults last year were roughly between high yield and leveraged loans. There was roughly 90 defaults last year. A lot of those companies that existed for too long, they're gone. And so now we're into a new regime where I think we're in a more normalized, what I would call a normalized market. Over 30 years, this is more normalized, where we're going to go through a normal cycle of defaults and recoveries that make more sense to us.
I mean, to talk about normal, the high yield index is, I think, 7.7% today. You and I did a lot of deals in the 2000 through 2007 timeframe when it was 10%.
Right.
So this cost of capital that we have today is actually quite normal.
Very constructive.
It's just not normal compared to the last 5 years.
But even with that, I mean, there's a lot of money chasing assets right now in this credit market. And Christina, I wonder if that causes not necessarily distortions, but maybe some lax behaviors.
So documentation and what we just, the high yield market, the BSL market has been extremely aggressive for as long as I can remember. I mean, I do remember the moments when 40% of the loan market actually had a financial maintenance covenant. Shocking. I mean, no one has a financial maintenance covenant. So the BSL, the syndicated markets, have been very aggressive for a long time. And so there are plenty of examples of what that could mean in a downturn. What I think is super interesting is the private credit market, which we haven't pivoted to yet, which is a huge growth engine in the capital markets, is also starting because of the supply-demand technical, where there's a tremendous amount of capital that has been raised, and now mega funds. We raised our own $21 billion private credit fund. It was just announced a couple weeks ago. That's a lot of money to put to work, and the deal flow is still not quite there. So we're starting to see not only spreads contracting in the private credit market from mid to high 500s. We hear there's a couple of deals about to get done at 450 over, which is sort of unheard of. But in addition, the documentation terms are starting to also mirror what we see in the public markets. And so the markets are starting to converge.
Yeah, I would say that, to Christina's point, they're converging at the upper end of the middle market. So, we in our platform, we also capital markets resides within our group, and we're financing our companies through that. And what's happened is it's allowed that pivot between private credit and the BSL market is allowing folks that have companies that are big enough to access both, if you will, that opportunity. And I think that's where you're seeing most of the tension. But Christina's right. I mean, I'm shocked. I was looking at some investment that came through recently where pricing is inside of 500. I think the key to difference is in the BSL market, we, since the great financial crisis, are used to having no covenants, and we're dealing with sponsors who are not worried about the relationship. And there's lender-on-lender violence, as we've talked about, and we experience that ourselves because we're, in so many credits. I think in private credit, in true traditional middle market, not the upper middle market, you're still seeing where relationships matter, and it's very hard to because there's a limited number of lenders in those groups. It's really hard to create that violence. Right. It's at the upper end where it's really overlapping with the BSL market, and that friction occurs.
Can we pause for a moment on the lender-on-lender balance? Because, we've been talking about the market normalizing, things looking a little bit like they were before. What has been the progression of that? Is this something that has reared its head again in a big way? Is it still subdued? Is it something you're worried about?
Well, I'm always worried because I'm a credit investor, but I would say that, we're just, I don't want to say we're used to it, but we're used to dealing with it. And what that means is lender-on-lender violence, for those who don't really, is basically you have somebody who comes in from the outside in a situation and can provide additional financing and then basically through the documentation put you in a more junior position. That's kind of the basis of it, if you will. And that's a bad place if you're a first lien lender in the BSL market. What's happened is, a couple of things have happened, is that the CLO market in particular has kind of coalesced a little bit more around the ability to keep that out. But also, a lot of companies, what's really happening, if you look at default rates, which are around 3.25%, if you will, over half of that is happening as a result of what I call distressed exchanges, where instead of going through default, a formal process, they come, we recut a deal, they give up a little bit, we give up a little bit, so we can refinance them. That's, you call that pretend and extend. I think it's more of it's a restructuring outside of the court. So I think the markets evolved to deal with the situation that the market that they are involved in, which is, Christina said, you're in a market in the BSL side where there are virtually no covenants, and you just have to deal with that. So I think all of us who have those types of businesses are learning how to operate in that environment.
And Christina, can I not look at that and say, okay, potentially some of this is happening because companies are weaker and trying to figure out a way to get around that, and that potentially this is cracks under the surface that a very headline busy market is maybe masking?
Look, I think it's going to be something we're going to deal with as companies just need a little more runway. Yeah. When you start to see this lender-on-lender violence, it's because you're running out of liquidity. and you have a maturity, and there's probably limited ways of extending that maturity. So I think it's going to be a flavor we see, but a lot of these companies are fundamentally very good companies, and, we'll probably, the markets will probably give them capital to sort of survive another day.
Right.
I don't think it's going to be the only thing we see. Now, if the economy in the world starts to turn down and we start to see real resistance to price, pushing price commodities through, then and the company's EBITDA declines further, I'm worried.
Right.
But right now, we have a pretty good economic backdrop.
Right. We only have a few minutes left, and I want to leave us on this, which is maybe the hardest question of all of this.
Right. Oh.
Mark, how much do you pay attention to geopolitics, and how much does it affect what you do day to day?
Yeah, I would say 34 years ago, I didn't pay any attention to it. I mean, I think 34 years ago, you focused on the micro level. I think after the great financial crisis, we said, wow, we should focus on macro and micro. And I think after we came out of the pandemic, the Russian invasion of Ukraine, we said, geez, geopolitics is actually pretty important. And, just to give you an example, if you look at container shipments today, all right, with the Israel, the conflict in the Middle East, if you will, what's basically happening is the Houthis are basically shutting down that area, which accounts for 15% of global trade. 80% of shipments that went through the Suez Canal are re-diverting. It's adding an extra 15 days to deliveries, and you can figure out what that cost is. So we came out of this very global environment, which we realized how fragile it was through the pandemic, and that it was overly complicated by global conflict, right? Like another great example is, if you remember in the Ukraine, when Russia first invaded, basically there were these clips, plastic clips that were made that were to hold together in the automotive process wires. And guess what? They're probably cheaper to make in the Ukraine than they were in Germany. And so that's where all of them were made. And once they stopped being made, guess what? You need that clip. You can't make a car. And that just showed how fragile the environment was.
And Christina's just continued. Now we have to deal with political volatility in France. That has had quite the impact on bond markets. So how much does it come across your desk day to day?
It's interesting. It's much more acute than it ever was. When the situation in France evolved, in the last week or so, the markets reacted very aggressively. Now the markets have settled down here in the U.S., but talking to my colleagues in London, any company that has exposure right now in France is very concerned, right? And so, I think we would never have paid much attention to the French elections, but now we're paying close attention. And so I think it's just one more element of volatility we have to pay attention to. And to Mark's point, we recently underwrote a situation where 40% of the company's production came basically out of China. And 5 years ago, we would have thought about it. We would have thought about the risks and probably moved forward. That's a pretty significant risk issue to handle, and how you price that and how you're going to package that for investors. So it's 100% front and center in a way that it hasn't been.
So I think we could probably spend another hour talking about this alone, but unfortunately we're out of time. Thank you so much. Everyone, please join me in thanking Mark and Christina for the wonderful
Thank
panel.
you.
Thank you.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Please welcome to the stage Raymond J. McGuire, president of Lazard, with Bloomberg's David Weston.
So, Ray, thank you so much for doing this. You and I never
it's
get
always good to be with you, David.
and vice versa, So, Lazard, your partner, Peter, has set some big numbers for you guys. I want to talk about how you're going to get to those, but let's start with private equity overall and where it is today. I mean, it had glory days, and then it really slowed down some, particularly when the interest rates got raised. Now it seems to be coming back. To what extent is the Fed interest rates actually affecting the rate of private equity deals at all, or is it other factors?
So let's define private equity. I would probably expand that to say asset management, of which private equity is one of the verticals within asset management. Today, we see the asset managers starting with the likes of BlackRock with, $10 trillion or so. You see the other ones who are now getting close to, if not above, $1 trillion. Private equity is a subset of the asset management world. So we see many of the institutional investors as well as the family offices investing in the asset managers. So their assets are growing. And the expectation is that'll continue to grow as investors are looking for returns that either meet or beat the capital markets. Fed policy has slowed a little bit of the deployment of that capital. And until we see valuations come in line, my sense is that you're going to see, at least for the private equity side of it, different to how they're deploying other aspects of the overall portfolio. Private equity has slowed a little bit in the activity. In terms of private equity's contribution to revenues on Wall Street, 30 to 40% and growing. So we expect that to be continue to be a large component of what's taking place in the capital markets and be one of the drivers.
It looks like there's a fair amount of capital out there to be deployed. Let's talk about the demand side, the need for it, particularly some big transformations we're seeing, such that we all talk about artificial intelligence all the time these days. And also you've got the energy transition. What are the things that are going to demand investment over the next 5, 10 years?
That's a much larger question. That goes to kind of the macro opportunities that we have, and I would put them in 5 categories. One would be generative AI. In the drop-down box there is the amount of capital that we're going to need to deploy in order to support generative AI. Data centers, as an example. Renewable energy or energy transition would be another of a macro trend. In the drop-down box of renewable energy and energy transition is how do we invest in the infrastructure that's going to allow us to remain competitive in energy transition and also be effective in how we go about energy transition. The other is, this has taken on a different nomenclature dependent upon who's communicating. It's either onshoring, friendshoring, deglobalization, or what I would call reglobalization. And the reglobalization means how do we invest in U.S. manufacturing? Remember, we peaked in U.S. manufacturing in June of 1979, where 1 in 5 Americans worked in a factory in the manufacturing base. Today, that's probably 1 in 20. And much of the dependence that we have in the manufacturing world for all the things that we do are dependent upon supply chain. So reglobalization is going to be another factor. The other factor that I would look to is the largest growing population that exists in North America is 65 years and older. And so how we drop down box, how do we engage in healthcare for that demographic? How do we manage the transfer of wealth or not? And the last is cybersecurity, macro themes. And the investment that we will have to make from the private sector is investment that we also today see being led by what's taking place in Washington. The IRA, as an example, the CHIPS Act, fundamental to how we compete going forward.
Just where I wanted to go, which is the role of private versus public in some of that financing. Because you mentioned the CHIPS Act, which obviously has a lot to do with generative AI. Government's a big player in that. Mm-hmm. And also energy transition, goodness knows with the IRA, government, big player. As we go forward, as you look at it from your point of view at Lazard, what is the right role for the government? What's the right role for the private sector in supplying the capital that's needed?
It's going to have to be a partnership, especially for the elements of the macro trends. In order for us to compete, it's going to have to be public-private partnerships, which we're seeing in many ways, I think, with the IRA and with the CHIPS Act. And look at the number of private enterprises that are involved in that with the support of the government. So there's those partnerships. And each one of these macro themes is going to have to be public-private partnerships. As we reglobalize, how do we invest in the elements of that reglobalization? The way that we do that is through, we need government policy that's going to be supportive, and then we need private enterprise to partner. And across the spectrum, you're going to see public-private partnerships that lead our ability to remain competitive.
Ray, how does that play across national boundaries? You talk about reglobalization. There certainly has been a readjustment, I think it's fair to say, when it comes to supply chains. And we even have a competition perhaps going on with the United States and the European Union right now in some of these areas. To what extent does this inhibit cross-border transactions, or does it enhance them?
Well, what you're going to see is the friendshoring to which I referred. If you look at today, 90% of the manufacturing needs of this country are supplied by China. So friendshoring, if I look at auto manufacturing in our relationship with Mexico as an example, if you look at biopharma and our relationship with India as an example, if you look at batteries and our relationship with Poland as an example, we're going to have to cross boundaries. We're going to have to rely on those relationships that have historically been friends of the United States as the global north and the global south at some point come together. We're going to have to make certain that we have relationships with our allies in order for us to remain in the lead. And we are in many fundamental ways in the lead, but where we are exposed from a supply chain standpoint, we need to be able to rely on our partners to reduce that gap.
There's a lot of talk about industrial policy and big investments for the U.S. government, and some money, goodness knows, has been appropriate, a fair amount of money. I'm not sure how much of it we've actually seen, as we would say in the business, up on the screen yet. I mean, talk to me, for example, about the Gateway project, which has been on the table here in the New York area for a good long time, and I'm not sure how much progress I've seen made. Is that a warning to us about the ability to actually get it done rather than plan it and even spend money on it?
So Gateway is a great example. As you all know, probably the largest allocation of capital by the U.S. government, where you're going to see prime examples of public-private partnerships. Why do I say that? Gateway, as you all know, is a $16 billion project with 72,000 jobs. And so what that's going to require is, one, the training of a workforce to fill those 72,000 jobs, from engineers to day laborers. And we also are going to need to make certain that from a manufacturing standpoint, that we have the industries that can supply the equipment necessary for us to go and drill. Gateway is a great example of that. And my expectation is that you're going to have private enterprise that are also partnering with the government in what the leadership of Gateway now is doing with Chris Kaluri and his leadership. I think they've done an extraordinary job. Bipartisanship, coming together, recognizing that in order for the trade that takes place domestically continue to be facilitated, that the Gateway project is one that is a high priority. If you also look at the implications on healthcare, Gateway in many of the communities that have not benefited so much or have suffered because of the emissions that have taken place across some of the bridges and tunnels, that it alleviates that. So Gateway is a great example of how the U.S. government has come in and supported infrastructure development that's necessary for us to continue to increase our growth in our overall economy.
Let me pick up on one of the things you've mentioned a couple times, which is workers. The number of workers, but also trained workers, particularly trained workers. In order to grow as an economy, you need more laborers. In the recent past, it appears that we've been sustained to some extent by legal immigration, actually, legal migrants being added to the workforce. What's the role of immigration in terms of the growth of the U.S. economy, particularly as you look at some of those huge projects where you need the workers and also the trained workers?
Well, apart from the political implications of that, first of all, we need to make certain that the workforce that we currently have is a workforce that is trained to be able to address the huge opportunities, the demand for labor. And my sense is that as you think about the IRA and you think about projects like Gateway and you think about the organizations today that train the labor, that there's a tremendous opportunity for us to continue to invest in that. Unions, as an example, how do we invest in that and how do we make certain that the unions are supported so they can go train the workforce? Reducing the requirements that you have a college degree in order to do some of the work that's going to be necessary. So workforce training is critical. By the same token, workforce housing is going to be critical. So for 72,000 people commuting into this geography, where do you house them? That's got to be part of the overall thought process and part of the overall architecture as we think about projects like Gateway. And as I think about what Gateway's, the implications of Gateway, profound and exciting, and a reflection of what we can do when we decide to invest in this country and invest in the most important part of the country, which is the talent.
When we talk about things like generative AI as well as energy transition, it's hard to have that discussion without talking about China somehow, because China has really put a lot of investment into those. There's obviously national security issues with China. At the same time, how can we get along, if I can put it that way, with China in terms of economies, so that we both get the best of it without conceding or compromising our national security?
So I would say when it comes to generative AI that we are ahead in the actual generative AI, the technology of generative AI. If you look at who are the architects of that, they reside in this country. So I take confidence in that when it comes to the energy sources that are necessary for energy transition. As an example, 70 to 90% of the raw materials necessary for renewable energy transition is refined by China. And so as we think about that, we'll have to reduce our exposure to the supply chain and invest more, which is why I come back to what we're doing with the CHIPS Act and the public-private partnerships that reside there, exist there, and other examples out there. So I would say there is a reliance today that we have to reduce our exposure, but that comes to not China, but China plus many, not China plus one. And I spoke about Mexico or India or Poland, or if I look at the global south coming from Tierra del Fuego up and the natural resources that exist there and the relationships that we are developing there to generate or to get our exposure increased to raw materials, the minerals, that's increasing. And I think there's an acknowledgement that we need to increase that. Another example would be the continent of Africa, 54, 55 countries, depending upon how you decide on one country. We have not invested there. That's where many of the raw materials come from. They exist there. The two challenges that we have when we think about the continent, they're two threshold challenges. One is the rule of law, the other is currency. We ought to be able to come up with a structure that allows for us to invest private capital, to invest on the continent in friendly relationships there so that we can access the material. How do we go about doing that? So you have to solve those two threshold challenges in order to attract private investment into those markets.
Ray, what does this all mean for Lazard? As I
Pardon?
said, how does it mean for Lazard? Because, as I say, Peter and you have set some pretty aggressive goals in terms of growth. What are the opportunities, all of what you just said, presents to Lazard? And for that matter, what are the challenges as well?
So for the opportunities, I think there are probably more opportunities than there are challenges. As you all know, we've been around now. This is our 176th year. We pride ourselves on being the trusted advisor to the most sophisticated corporate and sovereign leaders. If you think about much of what's taken place in sovereign restructuring, we have been in the lead of that. If you think about what's taking place today in renewables, and you saw announced a transaction between Rivian and Volkswagen. We led that. And there are numerous examples historically and today where we have been out front, both on behalf of senior managements and boards and also on behalf of necessary, important, sophisticated sovereigns. So we have played a leading role, and the expectations going forward will continue to play a leading role. We're onboarding talent to add to the existing galaxy of stellar talent that we have. And it's exciting to be, if I want to be anywhere, and I've chosen, you want to be anywhere, you want to be at Lazard, because we're at the forefront of a lot of what's taking place in the world.
Onboarding talent, is that one of the key gateways for you? How hard is it to find the right talent for what you need to do to grow?
Well, we're looking for A players, so, wherever we can find them, we're looking aggressively to help build on the tradition. I think if you think about storied brands and transactions and sovereigns around the world and who's been involved in that, we've been involved in that, and we are looking for talent. We've onboarded a number of talent today. We've had talent that's covering the sovereign wealth funds, covering the sponsors, covering many of the large consumer products companies, covering the healthcare space. So the largest spaces out there are technology, healthcare, and industrials, and we're onboarding amongst the best talent that exists on the street. That's a high priority as we go forward and achieve Peter's vision of 2030.
Ray, you mentioned you don't want to talk about the politics of immigration. So this is not a political question, but it does get to that. We have an election coming up in November. To what extent does that really take some of the wind out of the sails of companies like Lazard? Because companies are saying, let's just sit on our hands right now till we figure out what happens.
You know, I think companies are trying to decide where they fit geopolitically and geoeconomically. The strategy sessions are now in full force. The elections will have some impact as people digest the results of the election. But I'm not certain that history has demonstrated that's going to have such a material impact. Now, the policies that are going to be necessary to address some of the micro challenges are clear. Micro, I would say, policies to address education, policies to address, notwithstanding the fact that we have some of the lowest historic unemployment rates. In many of our communities, you've got pretty high unemployment rates. Policies to address health care. So those policies will have an impact at a local level, and we need to address those. So the administrations, whichever administration is in situ at that point, will have to address those.
Finally, we tend to focus on the United States and New York here when we're situated here, which is often a mistake. You're a global firm. You're dealing with global clients. What about the level of geopolitical uncertainty that goes well beyond the elections here? And we've got elections coming up, obviously, in France, in the UK. There have been so many elections, a lot of which were surprising, particularly for incumbents. How is that affecting deal-making? That is to say, there's just more of a geopolitical risk that you have to take into account than you did before.
You know, we have a geopolitical risk team, and they are in demand, in large part because of what you said. Corporations and sovereigns are trying to digest the implications of the 50-some-odd elections that are taking place around the world. We see the pause that's taking place in France now. We see the scenario planning that's taking place in the U.S. Having said this, as we go through all the geopolitical uncertainty, the country, which today is a country to which the world continues to look as the United States of America. So if I look at that and I look at some of the policies that are been implemented and the allocation of capital to the future, I couldn't be more excited about what's in front of us and what's ahead of us.
It's great to talk to you. It's a great note to end on. Thank you so much to Ray McGuire, president of Lazard.
Please welcome to the stage Bloomberg's Michelle Lynn.
Hi again. I'm Michelle Lynn, Global Head of Data Science and Insight for the Bloomberg Media Organization. Over the course of the summit, I have had the wonderful opportunity to help conduct polling questions that have been crafted by our participating sponsor of Bloomberg Invest, Southern Company. This is our last poll, so it would be great if we could have 100% participation rate in this. Whether you're virtual or in the room, we would love for you to participate in this poll. So if you could take out your phone for one last time and scan the QR code. If you scan the QR code, you'll see the polling icon come up in the bottom right-hand part of your screen. And the question that Southern Company would like us to answer now is, blank is the primary driver of my sustainable investment focus. And the answer options are aligning to corporate and internal values, changing, evolving stakeholder expectations, and long-term results. Again, the question is, blank is the primary driver of my sustainable investment focus. So if everybody could please register your answers now for our final poll. All right. And here are our results. So 56% or so are saying long-term results are the primary driver of my sustainable investment focus. About a quarter, 24% aligning to corporate internal values are the primary drivers of my sustainable investment focus. And 19% are saying changing, evolving stakeholder expectations. Thank you all so much for participating in the polls over the last 3 days, and thank you so much to Southern Company.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
Please welcome to the stage Nick Laster, founder and chief investment officer of Lycos Global Management, and Rebecca Lynn, co-founder and general partner at Canvas Ventures with Bloomberg's Caroline Hyde.
Either end of the spectrum here when it comes to private investing, going into public investing. And I want to sort of launch trade in on what on earth it is like to be writing checks at either end at the moment. So with Lycos, of course, Nick, you are looking much more at the late stage rounds, IPOs, maybe just very recently gone public companies. And then Rebecca, with you, you're more in the Series A, the Series B. So Rebecca, kick us off.
Yeah.
Is it competitive?
You know, it is competitive. But for how we approach the market, we really have a lot of runway in front of us because we spend a lot of time on our core investment theses. And now with Gen AI, which who hasn't heard of that, right?
I've never heard of it.
Never heard of it. There's so many really interesting opportunities from founders that have done multiple exits in the past, multiple companies. And so we've done 3 this year, and the pricing is back down to pre-21 levels, all with the Gen AI focus. But you have to really know what you're looking for, and you have to know what to avoid.
Okay, so Nick, if we're looking at Lucas's approach right now, you've of course come out of Soros, raising your own fund already in CoreWeave, for example, which is one of the pinups in AI. Was that a hustle to get into? How competitive is it?
It was. I think it's the onus is on investors to do something other than just write a check because capital is something of a commodity for us, and particularly with CoreWeave, Mike, Brandon, and Brian. It came down to our ability to help them tell their story in a way that was going to resonate as they transition to public markets.
That's a PR's job, Nick.
But no, it's an exceptional asset. We were humbled to partner with them. But it requires investors to hone and clearly articulate their value prop.
So we already have brought up Gen AI. So Nick, if a company right now is at the upper ends of raising money, actually might even be eyeing the public markets, does generative AI have to be in their story? That's your key selling point. You can help companies tell a story. Does it have to be a Gen AI story?
It certainly doesn't hurt. I think companies that have AI exposure or credible AI story are certainly in a very different situation when it comes to IPO demand. If you look at deals this year, 2 come to mind, both successes, Reddit and Astera Labs, March IPOs. Astera was a pure play AI narrative, and Reddit was a complementary AI narrative. They're up 60 and 80%. But irrespective of whether or not you have a credible AI story, if you're a CEO, if you're a founder thinking about going public in the next 2 to 3 years, I think the things that really matter, identifying partners that you can see yourself growing with, building a robust finance function, and identifying the KPIs that are going to drive value not only today, but going forward. There's always going to be public market demand, AI or not, for businesses that have durable growth, strong unit economics, and a line of sight on free cash flow.
Does that also ring true in the Series A, Series B space at the moment, Rebecca? How much are you looking at the public valuations and having to either down round it, or actually are companies managing to grow into their valuations at that stage?
Oh, for our companies? So for us, we're early growth. So we're Series A and B when the companies have a product we can get our hands on. And then what we're really good at is helping them scale and develop their go-to-market. And that, like a strategic consultant, just like you said, companies now really, especially the experienced CEOs more than ever, are looking for investors, whether it be my stage or yours, that can really be a partner with them and help them strategically go through the process, right?
And so it's very important for us that, I always tell founders they need to know where they would land the plane if they had to, right? and how that would work. And so we work very early on like, what would it mean to be profitable? What people in our ecosystem do we need to actually partner with very early? And we encourage our founders to go out and do that years before the IPO word even comes into their board deck, to really think outside of their existing company and think very strategically.
Rebecca, on that note, how often are those partnerships becoming M&A opportunities rather than actually going public via IPO?
Well, an M&A opportunity almost always comes from a partnership. It almost never comes from a cold start and a sale process. And just last year, Casetext was bought by Thomson Reuters, right, for $650 million.
Big AI play.
Probably, I would say, still the most robust implementation of GPT-4 that exists. And they did that because of partnership opportunities, both with all of the AI LLM players. They've been in that space for a decade, right? So they had the sandbox of GPT-4 in July of 22. And that comes from these really strategic outreach motions that they did. And then Thomson Reuters knew them well just because of their outreach they had done and the partnerships they'd done in the ecosystem.
What's interesting is we're seeing some rather novel types of partnerships and novel types of M&A actually going on at the moment, Nick. I mean, you're in CoreWeave, as we mentioned, they're trying to acquire an asset at the moment. But more looking at the large language model plays, OpenAI having relationships with Microsoft and others, but then you're also seeing Anthropic being funded by Google and Amazon and having partnerships. Then you get acqui-hires like we've just seen with Inflection.
I think it's called AI money laundering is one of the posts that came out, right?
I love that term.
She said it, not me.
There were some articles out there about that were pretty interesting, actually.
What would you say of these partnerships and M&A opportunities at the later stage?
Yeah, I think, look, in aggregate, it speaks to how integral these smaller private players are to hyperscale AI platforms and to offering end-to-end solutions and capabilities to their customers. As it relates to Inflection and Microsoft, I think it also speaks to the regulatory climate, right? That was positioned and structured as an investment to license their model. You're also seeing a pickup in deal terms, regulatory break frees and the like. It's going to be harder for big tech to do big M&A.
Because of regulatory? Yeah. Well, and we saw that too with Casetext. I mean, Thomson Reuters came out just months beforehand and said that AI would completely disrupt their entire business. And they acquired Casetext, and Casetext, by the way, already had 10,000 of their own users. But they needed that experience and that platform really for their business going forward. And I think we're going to see more and more tech M&A for that reason from these very big players.
Interesting. Let's use Casetext as a case study. Because you, wrote the check into that in 2016. So this isn't an overnight success.
No.
But we do feel that generative AI has sprung up out of nothing, and suddenly there's a fight to get into these companies and valuations that just feel so extreme. How are you rationalizing what is a good AI opportunity or not?
Yeah, no, it's a great question. So we've been in, let's say, not Gen AI, but AI, machine learning since we did Siri when we were the first investors there. And then we've had a number of outcomes, including Figure 8 and Luminar in AI. And, although it feels like it came out overnight, right? And really the algorithm started like 2017. And so the companies that were best positioned to take advantage of GPT-4 were companies that were already in the space. I mean, Casetext, because they were taking the place of a legal counsel, had to be at really the bleeding edge of LLMs because they were writing text, right? And so they had access into all of that. And it was an evolution over time. But I've got to tell you, GPT-4 was just like a light switch. And the best comp and explanation I have is that the Casetext team had tried to pass the California bar with GPT 3.5. And the best they could ever get it to do was roughly 30%, score. Pathetic. Although the California State Bar, the average is 68, so also not great.
Speaks the ex-lawyer.
Exactly. So but when they put GPT-4 against it, it was 94%, which was better than the lawyers. And that was in a very, very short period of time. So I think we just saw the step change incredibly suddenly. And the companies best positioned to take advantage of it were companies like a ship. They already had steerage and momentum going into it. And they could pick up the technology and plug it into their existing systems and customer base rapidly.
Look, it was a light switch, and it was also a light switch for many a market valuation. And we talk about NVIDIA day in, day out. It's now more than $3 trillion. I mean, it was at $1 trillion when we started the year. I mean, this is a phenomenal rate of growth. Nick, have you seen equivalents of this? How do you explain this to the LPs coming into your fund as to what the opportunity is for market capitalization growth?
Yeah, I think if you zoom out and you put this into context, from 2012 to 2021, on the back of extraordinarily low rates, you had U.S. VC investment grow eightfold. It was $330 billion in 21. You had more unicorns created in 2021 than you had in the prior 5 years combined. So there are a number of companies that have been overcapitalized, if you will, at a different cost of capital. Yesterday's cost of capital.
When it was zero.
About half of the unicorns last raised when rates were below 1%.
Wow.
So those valuations, while stale, can persist as long as cash burn and cash runways permit. There's some good data that's come out recently that would suggest that about half of the 740 unicorns in the U.S. Will need to raise by December. So I think it's a question of when, not if.
And are they, Rebecca, the right ones to be betting if they're running out of cash, but they have valuations that, I mean, need to be downgraded? Who are you looking at that is eyeing the public market but just can't at the last round that they raised at, I assume?
I'm sorry. So companies that are in this situation, right, are going to face just really one of two consequences. One, or three, unfortunately. One, they take their medicine and they take a massive down round, and hopefully the investors are on board with a complete recapitalization, which restructures the entire company. That's one option. And that we're seeing 30% of company or fundraising right now in that later stage actually be down rounds and largely inside led.
Of the ones that are disclosed?
Of the ones that are disclosed, yes. Other things, other ways they're doing this, I would say it's much bigger than that. People are just doing, a note document, right? Which is not disclosed. Good point.
So explain that, sort of a bridge finance.
Yeah, so it's bridge finance. They do it, instead of doing like an equity financing and disclosing that, they do more of a safe note or a bridge of some sort where it's really sort of, debt capital going into it more or less, but it will take the form of equity. And then the other option is they sell the company to a public company. Now, the problem with that is these companies have incredibly high burn rates typically. Mm-hmm. Not ours, because we try to manage that very well, because we've seen the show a couple times. But, a company's not going to acquire a company for what has, is burning $5 million a month, which some of these still are. And then the third option is sort of the least favorable, is they just close. They go out and kind of quietly go away, right?
But a big company can't quietly go away.
No, I mean, we saw Convoy, not that long ago, go to zero overnight. And so I think we'll see more of that.
What we might see, though, is actually companies taking their medicine, Nick, and deciding to go public at a slightly different valuation than was the previous. And we've actually seen that already. Instacart swallowed that bitter pill, came to the market, and, well, people might question as to how well they've traded since. But I'm interested as to how much you see the opportunity for companies to make that bold step, to decide to go public, to become a publicly traded company with all the scrutiny that goes with it.
Yeah, I think there's certainly pros and cons to it. Look, it's a long road. I don't think, an IPO is the end in itself. It's a milestone on a multi-year journey, and ultimately, their success will be proven out in public markets as they execute. There has been a very acute, if not myopic, focus on headline valuations. But I think slowly you're starting to see people reorient and valuation expectations recalibrate.
How long do you stay in a company once it's gone public?
Yeah, it's hard to generalize, but look, we like to think about businesses in terms of years, not quarters. And duration is a competitive advantage for us. It's a competitive advantage for CEOs as they try to build something enduring.
How painful is that? And I'm going to bring up a relatively interesting case study of yours. You made your name in many ways, some really incredible bets you made with Soros and the companies that then went public, one of them being Rivian. Now, today is a very good news day for Rivian. Mm-hmm. Shares are popping about 40% last time I looked because they've done a deal with VW. But it's been pretty painful in the interim. Yeah. How long did you understand that, look, you've got to stay with this company for the long term? RJ is going to get us there, but it's not an overnight success.
Yeah, I think, look, you're going to find out what type of investors you have when things are not going well. I think that the smart CEOs, the right founders, appreciate the value of staying power. There will be missteps inevitably. There will be execution faults. But I think the onus is on those companies to communicate in a way where they're straightforward and they're clear and they're transparent. That's what being a public company CEO entails. CFO too.
But part of your staying power probably is driven by really knowing the company well and the market and having a really informed thesis about how you're seeing it. And I think that's important for any investor. You know, for a CEO to really find an investor that understands that space, that does their own work, that actually goes out and talks to the consumers of that product, I think is so important. And so few investors actually do that. But that's really what builds conviction for us, either early stage or later stage. Because we can often sell really earlier, or we have to make the choice. You know, with Case Text, with Figure 8, with Gabby, with Future Advisor, you know, we had term sheets to finance it. And the question is, do we finance it and keep going, or do we sell? And is this price the right price? And that's a question that you can only answer if you do the work, just like when you're a public market investor. And it's interesting that, you know, we do see the bad behavior now of investors that were sort of, you know, tourist investors that came in and thought it was just, you know, throw in some money and cook, right? And it's not. It takes a lot of work, and you have to really enjoy the job.
Yeah.
Talking of, well, startups in actually the going public space, I just got a quick poll for you. We've only got a couple of minutes, but you've got a couple of minutes to have an audience participation moment. I want to ask you a question on what you thought about this Texas exchange, which, of course, I think Citadel's behind it, some other key players. Do you think the newly announced Texas Stock Exchange could potentially compete with the New York Stock Exchange and the NASDAQ? I want you to get voting. Use your phones. Use the QR code. I want to know if you think it's not a chance. We could see some market share moves southwest. Companies should welcome the competition. And it's interesting. We've got a few companies, big, privately run companies and publicly run companies moving to Texas. Elon Musk is behind a lot of them, and I'm sure he might well be a player of taking companies public over there. But Nick, is it good to have competition in the exchange space as well as competition in actually companies going public?
Look, I think innovation, you know, markets, venues, structures, this is all good for markets. It's good for investors. It's healthy for companies. I think what's interesting about the Texas Stock Exchange is twofold. It's one, an attempt to provide public capital to private companies, but it also speaks to some of the onerous burdens of being a public company from a regulatory standpoint on the NYSE or NASDAQ.
Great. And sometimes you need that safety net there. Interestingly, I think we have a few New Yorkers in the room, because the 40%, the majority think there's not a chance the companies are going to move to Texas to go public. But just as we wind up this conversation, I want you both to give a piece of advice to those who are looking at doing their due diligence, who are wanting to perhaps either get into the private space or into, indeed, companies that are about to IPO. What due diligence should they be doing? How to ensure that they're not tourists, as you labeled them, Rebecca?
I think you have to talk to the customers. You have to really understand why the customer, whether it's consumer or enterprise, you know, why the customer is using that product and what their go-to-market motion truly is, and if it can scale.
Might be easier for a Rivian or an Instacart consumer than perhaps some of the more deep in the weeds AI trades. But Nick, as you're out there sort of crossing the T's, dotting the I's on LPs committing to your fund, what's your piece of advice that you're saying to them to commit capital to you? What would you say for the story you're about to tell?
Well, look, I think everything is downstream of competitive advantage. And that's true for investors. It's true for companies. Being aware of your circle of competence and kind of sticking to that is the onus is on investors to do so. If you don't have an edge, you shouldn't be participating.
I agree.
Keep bringing your edges to Bloomberg. Keep coming on Bloomberg Technology and across all of our bandwidth and our platforms. It's been a joy to be with both of you in front of this wonderful audience today. Thank you for your participation as well. We love it. We want to thank Rebecca Lynn and Nick Lancaster. Thank you very much indeed.
Thank you, Caroline.
Mubadala's commitment to deploying capital purposefully echoes the vision of the UAE's founding father, a reflection of our values to better advance humanity and help find solutions to global challenges through investments that are durable, global, and above all, responsible. Our strategy to invest in industries shaping the future supports our vision of a brighter tomorrow for us and generations to come. Mubadala, investing for the future.
Please welcome to the stage Mark Attanasio, the co-founder and managing partner of Crescent Capital and chairman and principal owner of the Milwaukee Brewers Baseball Club, and Tom Werner, chairman and co-founder Fenway Sports Group with Bloomberg's Jason Kelly.
All right, so we're sitting between you and lunch and the rest of your day. And so what better to talk about? Or maybe what we're standing in between is a golf game. Go figure. Probably not. This is way too high octane a crowd to be out on the golf course on a Wednesday afternoon. But we're talking about golf. We're going to talk about sports. I'm so delighted to have both of you here because you are at the white hot center of something we all care deeply about, which is the world of sports. I want to start with golf. You guys are both part of the Strategic Sports Group, which made a big investment in the PGA. And I want to put up a couple slides that, Tom, you were nice enough to share with me that talk about the growth of the game and the opportunity that presents itself in golf. If we can get those slides somewhere. Okay, it's really big. There we go. So there's U.S. I mean, these are staggering numbers, and I think maybe I certainly, when I looked at them when you sent them to me, I was surprised at how big these numbers are. Can we go to the next one because it gives the...
I just want to say one thing.
Okay, please.
The first slide is about the popularity of golf in the United States. Part of what made us all excited about it is that this is really a global sport. So, when you think about the $102 billion spent in golf, that's in the United States, and of course there's a bigger number worldwide.
Yeah. So let's look at the global numbers, because it does feel like that's at the core of this business case. So that if we go to the next slide about the global, I mean, that is a staggering number, almost 400 million people. So, Mark, I want to start with you. Why do this deal? I mean, obviously the numbers pencil out, but golf, if you look at it, if anyone follows the headlines, not exactly, it's not a mess when it comes to a business. Is that part of the attraction?
Well, it starts with the macro and the brand.
Yeah.
And I was sitting, I'm on a committee with John, actually a couple of committees with John and Tom at Major League Baseball, John Henry, and they were talking about the opportunity here, but I didn't realize that what they were working on. They just talked about some of the challenges that were being faced. And I said to John, well, to me, given that brand, the more challenges, the more opportunity.
Right.
33 years of investing at Crescent, that's what we found. You know, the easy investments don't really create a lot of opportunity. The more difficult ones do. So Tom and John called me a few days later and said, were you really serious on how you looked at that? And would you invest in the PGA? And 100%, of course. And I still didn't know what they were working on. And then they let me under the tent, and it's extremely exciting.
And so, Tom, what was it for you? I mean, you know, your Fenway Sports Group, obviously the Red Sox, Liverpool, Pittsburgh Penguins, Nesson, the Sports Network, and more. What was it about golf that jumped out to you?
Well, as most of you know, the structure of golf a couple of years ago was that it was a nonprofit, and the players were independent contractors. And so this now is a league that the players are now owners. They have equity in the league, and this SSG and Fenway Sports Group are really investing in the commercial growth of the game, And of course, it all starts with, what can create a better fan experience. And, we are grateful that we were selected because it was a very competitive situation to invest in the new structure. But, we think that, and Mark is part of this group, that the operational experience that we have in sports can benefit the players and be a resource.
And so take us inside this proverbial tent a little bit. Like, what do you need to do? Like, what's the low-hanging fruit here? And what are the things you're seeing that can be relatively easily fixed or changed to improve those elements?
Well, one thing that Jay Monahan, who we think is a very strong leader, is doing is we are commencing a very extensive research study that is called Fan Forward. But Rob Manfred did the same thing in, I think, 2019, where we did a survey about what was good about baseball, how to make the experience better. And, a lot of positive changes have come from that. But we're going to be listening to our fans. And, just one idea that we've been talking about is when you think about the experience of going to an event on the tour, that we are trying to eventize it and make it really more must-see. And somebody at the PGA was looking at Louisville. They have an event every year that is really just 2 minutes long in its actual composition of the Kentucky Derby, but around it they have a week-long festival. So one of the things that we're talking about is how to create experiences at PGA Tour events that will make them more attractive.
And so, Mark, as you look at this, you're a global investor. Obviously, one of the elements that is clearly at play here is LIV. What needs to happen?
Well, if you look at the golfers, whether they're at LIV or PGA, these are some of the best athletes in the world. And across all sports, you want to see the best athletes competing against each other. That's why, for example, you have so much interest in the Olympics. And so we hope to be a bridge or a catalyst to try to bring the golfers back together so they could compete more than just a handful of times each year.
What's your level of confidence at this moment that that'll happen?
Well, look, we're all optimistic, right? We know so we know how difficult it is and what the hurdles are, including some regulatory ones.
Yeah.
But it really should happen, and so I think it will.
And so, Tom, when you think about, one of the things that's very compelling about sort of the data underneath this is this notion of sort of off course. Many of us in this room, for better or worse, go out and hack it around the 9 or 18 holes. But increasingly more people, especially younger people, are experiencing golf in different ways. How do you, through the PGA, monetize? I mean, how do you take advantage of that movement toward the top golfs and the sims and whatnot?
Well, the first thing is to acknowledge that one factoid, I think it was up there, is that more people were playing off-course golf in 2023 than on-course. So they're both growing, but off-course golf, things like Top Golf, is very attractive. So, it is all about the popularity of the game. One of the great things about golf, as opposed to the NFL, for example, which, has its own great attributes, is that people are playing it, and so when they're watching golf, they are participants in the sport. So, whether they play golf at their country club or they're playing mini golf, at their local hangout, it's all good for the game. And that's, 5-year-olds can play. Our Hall of Fame announcer, Bob Uecker, turned 90. He still plays golf.
Right.
Pretty well, actually.
Right.
And
what about both of you? I mean, Tom, obviously your experience and success in the media world is very well known. You have created, many beloved shows, or still creating beloved shows on multiple platforms. What's the media side of golf? And then I want to talk about some other sports. But what's the media play here for you?
Well, I think we focus too much on Nielsen ratings, even though they're obviously very important. But
the platforms that golf is on, the social media, people it's growing exponentially on social media, and it's all about how to communicate the game to the consumer in a variety of ways.
And so what's the non-obvious, Mark, last golf question for now, what's the non-obvious thing that could help golf in your mind? Like, what's the surprise? As you got into it and said, oh, this is a nonprofit, they're doing this, they're doing that. Like, what was the thing where you're like, oh, well, just do this? Or, that it surprises me that this is going on here.
Well, I think the best athletes in the world want to compete against each other.
Yeah.
And so underlying, however we got to where we are now, you would think they'd want to be able to go head to head. And I'm hoping that undercurrent will prevail.
So let's talk a little baseball, if we can. Both of you are, owners of Major League Baseball teams. And when you think about this, we were talking a little bit about this backstage. Tom, this was a sport, baseball. I grew up watching it. I'm sure many people in this audience did, and folks, watching this. And yet, it seemed to be running into a little bit of trouble over the last couple of years. Competition committee, gets together and makes some real changes. It feels like it's made a difference. Tell us what it looks like from your perspective when you actually get down to the numbers.
Well, we know it's made a difference because the fans have told us that one of the most important changes, and Mark and I are very supportive of all these changes, is that the game was too long. We all knew that. It was over 3 hours in length for a 9-inning game. And the pitch clock really has transformed the game. Now the game averages about 2 hours and 35 minutes per game, and so people were not leaving in the 6th or 7th inning. But that's just part of an initiative to make changes. The NFL makes changes every year, and nobody notices it, and every change in baseball is scrutinized. But along with the pitch clock, we've made some other changes. We now have rules about defensive alignment, which allow more balls to be in play. The size of each base is larger, which encourages stealing. And so there are rules that have already been implemented. And last year, again, another factoid is over 70 million people came to Major League Baseball games, which dwarfs the combined attendance of the NFL, the NBA, and the NHL. So we could do probably a better job touting that, but people are going to baseball games.
The minor leagues, the most watched sport live in the country is Major League Baseball. The second most watched sport is minor league baseball. So, the game, and I think a lot of the demographics don't get picked up. You have increasing interest from Latin American community, for example, and it's not clear that all of that younger demographic interest is picked up in the numbers. So, look, there's nothing more riveting than the 9th inning of a baseball game.
Right.
And to Tom's point on the some of the changes, the pace of game, the action. So 2 years ago, you'd have the shortstop in short right field almost like a softball player, and the ball would go right to them. Now you've got second baseman diving and making plays. There's a lot more action and a lot more, for the fans to engage with.
One of the underlying themes of both of your investments, and the golf thing fits into this too, is this sort of global view. Mark, you more recently have gotten into the world of football, soccer. Tom, you've been there, via Liverpool. What is it that you take from that experience and you apply back to, some of your U.S. Side investments? Tom, I'll start with you. Like, what have you picked up from Liverpool? You're like, okay, we need to do that either from a management perspective or an organizational perspective.
Well, the Premier League, and Mark is involved in English football too, is a very popular sport globally. Sometimes we have that narrow focus of the United States, but we are very pleased to be in the Premier League, and many more people watch a Manchester United Liverpool match than the Super Bowl. So we're aware of that, and part of what we bring to all of our investments is relationships with sponsors because they fuel our growth. Part of our operational expertise is the relationships we have in Liverpool, for example, with UPS, Google. This week we announced a new partnership with Japan Airlines. So, we are excited to be in the Premier League.
So, Mark, you looking at that saying, I'm sorry, did you say relegation? Like, what promotion, relegation, what?
Well, what created the opportunity for us was relegation. Norwich City Canaries were relegated from the Premier League to the Championship League, and that's what created, out of adversity comes opportunity.
Yeah.
And what I've taken from it is this team, this club has been in existence over 100 years. They have the oldest fight song in English football. And what struck me, I really knew very little about football or soccer. I was somewhat the Ted Lasso of owners, was that the fans were called supporters. And the way you engage with your supporters is meaningful in such a way that almost when you're born in Norfolk County in the east of the UK, you start wearing yellow and green. So we've looked how to take that sort of feeling and bring it to Milwaukee, where we have a natural, fan base that grew up with the Milwaukee Brewers, and we've learned a lot of lessons from that.
And so as you look across, we just have a couple minutes left, but so as you look across the sports opportunity landscape, you do this golf deal, it's, $3 billion. The amount of money that is pouring into sports is breathtaking, and I sat on this stage earlier with Josh Harris and talked about that. Do you worry about sort of the cost and the valuations getting so high, Tom? Like, what do you look at? You guys have been doing this for a long time now.
Well, I look at it differently. I think that, and Mark would agree, that as an asset class, investing in sports has been demonstrated to be very attractive to investors, and more people are investing in sports as an asset. We are in partnership with Redbird Capital. We're in partnership with Arctos that has a fund that invests in multiple teams in major sports. So the fact is that sports as a part of life is immensely important, and it's one of the things that brings people together. And obviously there's revenue implications for that. And the live event business is booming. So I'm very optimistic about the future of sports and the future of teams in a world in which there's obviously scarcity value.
So, Mark, anything that you're like, nah, I'm good for now when it comes to sports, or something that you want to get into that you haven't yet?
Well, to the point on some of this, 20 plus years ago when I bought the Brewers, I knew in fact, my wife came into the study one day, my wife Debbie, and said, "You're not going to lose all our money, are you?" And so I had the Bank of America did a study back 20 years ago that showed it was a non-correlated asset class that didn't, would be somewhat recession resistant, which sort of is. We found in COVID that, that might be different for what's a live event business. But so look, we're looking at everything from women's volleyball to professional sailing, and other leagues to invest in. But I think at some point there'll be differentiation. There's some sports that don't make sense to me. What's probably the greatest opportunity is not just clear what the lane will be is college sports.
Yeah,
and enormous revenue opportunities, and that they're not organized yet. They're getting organized to take advantage of it. So we've made a toehold investment in a company that's involved with the Big 12, and we'll see.
So, Tom, we'll sort of wrap where we started with, with golf, this big opportunity. What does success look like for you? As you sort of embarked on this, you put together this pretty incredible roster of investors. A year from now, 2 years from now, what does success look and feel like?
Well, we're patient, but success is the fact that the best players will be playing in events in a schedule that works for the players and the audience.
Mark, agree?
FSG has a real sense of urgency here, and I think that's going to prove out.
Gentlemen, really good to spend some time with you. Best of luck to your teams. I'm sure there are people in this room that are actively rooting against some of your teams, and that's okay. We're in New York, Tom. Give us a break. Anyway, thank you both so much. We really appreciate it.
Thank you.
Thanks. All right. Thank you. All right. Don't leave. I just have my closing remarks. I've got to do my song and dance. So we're done. Thank you so much for joining us today. We hope you enjoyed our conversations. We certainly did have a lot of fun bringing it to you. Thanks to all my fellow moderators. I did want to give a big thank you to our sponsors, our presenting sponsors, Android, Invesco QQQ, Mass Mutual, and Mubadala, as well as our supporting sponsor, Principal Asset Management, and our participating sponsor, Southern Company. If you want any information about our sponsors, go to the resources tab on our event website and go to the YouTube page to see all the things you've already watched or things that you may have missed. And we do have some breaking news. We always like to give you a little bit of news. This event will be moving next year to March. So March 2025, we'll reconvene our Bloomberg Invest Conference. So be on the lookout for more details about that. Thank you so much for coming. We'll see you next time.